Dear viewers, welcome to this episode of Expert Speaks. These are troubled times. Markets are going through a corrections. What people thought that the market will end its correction and move up immediately, and that's not happening. Week after week, we see markets coming down. Nobody knows where the market is heading towards, how long this correction will take the markets down, or how long it will persist. These questions need to be answered by experts. To answer all these questions, in this episode, I have invited a very prominent speaker, an eminent guest speaker by name, Mr. Chak Patel, and he's going to take you through the lessons from the history and the practical insights of managing funds during the market corrections. Stay till the end of the video. Very, very interesting points, very, very interesting observations from various market corrections of the past. We are going to share with you, and that will help you. And if you stay till the end of the video, there are many points that you can take home and you can come out as a successful investor. This is NRI Money Clinic for you, and I am Dr. Chandrakant, but your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, to talk about the market corrections, what you should be doing, what you should be avoiding, what are the things that you should keep in mind when you invest during the corrections, after the corrections, and how you have to manage your portfolios. To talk about all these things, we have a very, very prominent expert speaker today, Mr. Chak Patel. Mr. Chak Patel is a chartered financial analyst. He is co-founder at Valuemetrics Technologies. Mr. Chak Patel comes with a very, very rich experience of more than 16 years. In the recent past, he has worked with White Oak Asset Management Company, and he was instrumental in designing many of the schemes floated by White Oak Capital in the recent past. Prior to that, he has worked for more than 15 years with ICICI Prudential Asset Management Company. And for those of you who have heard about the Freedom SIP, Booster STP, and many of these things, the industry first initiatives were developed by Mr. Chak Patel. He has seen many market corrections. He was in the middle of management of funds when the corrections were happening. He understands how the investors behave. He has seen what happens during the bull market, when the bull markets give up, and when the new bull markets starts all over again. It makes absolute sense and to take inputs from him to pass through this corrective phase and come out victorious. Welcome to this episode, Mr. Chak.
Thank you, Mr. Chandrakant, to invite on your channel once again. So it is always happy to connect with you.
Chak, you have been in this industry for such a long period of time. You have seen countless market corrections of various depths. And you have seen how investors panic, behave, do wrong things during the market correction. In our episode today, I want you to guide my audience from the lessons of the history and the observations you have made so that they will become good investors here. My first question to you is, from the various past corrections that you have seen, how does this correction look like in comparison to the past corrections?
So just wanted to say something about corrections. There are three things that you have to keep in mind. One is you have read about correction. Second is you are observing the correction, but you have not invested into it or before it. And the third thing is you have invested and you are going through the correction. At these three occasions, your reaction to the correction would be very different. You have just read about it, so it is very easy. I would have invested. But when you have not invested and the correction is going through your lifetime, then okay, I will do something about it. But when you have already invested and the market is correcting, your emotion would be very different. You are the same person. So in my career, I have seen many corrections, but in the history from 1991 to till date, there are 48 corrections which are more than 5%. So if we divide this correction into three grades, one is correction of more than 5 to 10%. Second is correction between 10 to 20%. And the third is correction more than 20%. This is a third grade correction. So the first grade correction is between 5 to 10%. There are 27 such instances in the past. So you can say every 1.5 years, you can see this kind of correction. Then there is a second grade correction, which is between 10 to 20%. There are 12 such instances. So you can say every 3 years you can observe this kind of correction. And there is a third grade correction. There are 9 such instances. So you can assume that you can observe this kind of correction every 4 years. So it is part and parcel of investing. So if we look at the present correction, it has moved from the first grade to the second grade. Now it is almost 12% corrected, right? And from the history, what I have learned is every correction is recovered, right? And at the time of correction, we talk about risk. And after it recovered, we think that it was an opportunity. So every time it happens, when it is correcting, you think about risk. And when it recovered, oh, it was a great opportunity to invest. And that is what I have heard many a times. So I have seen at least 25 correction in my working career, right? One is your learning career and one is your working career. I have seen in my working career, I have seen 25 such correction, and it looks like an opportunity once it's recovered. But when it is correcting, you think a lot about risk. And with every 5% correction, your knowledge increases by 10%, but your courage reduces by 10%. So after 50%, you will have 100% knowledge and 0% courage. So when there is an opportunity, either you don't have courage, and if you have managed to gather some courage, you don't have money to invest. So that is what is common about all correction. But currently, this correction is a second grade correction. And now how to read it is a different matter.
Chirag, the headline news daily is markets are correcting because FIIs are selling. And because FIIs are selling, even the forex equity has dropped. Is it that the first time the FIIs are selling in India, so it's something to be really worried about? Have FIIs sold in the past? What has been the behavior of FIIs during the bull market, during the bear market? What have you observed during that working career of 15, 16 years in the past?
So first thing, for a market to correct, there has to be on aggregate level a desperate seller, right? Without a desperate seller, there can't be a correction. So you just don't require a seller. You require a desperate seller. Why I'm telling it? Because see, when there is a seller, there is always a buyer. So it is never a point that if somebody is selling, there can't be a buyer. There is always a buyer, but the seller has to be desperate. Now, sometime on aggregate level, FII could be a desperate seller, or sometime the DII could be a desperate seller, right? And sometimes both can be a desperate seller. Then there are very few buyers. The buyers are actually not the desperate one. So this time the FII is a desperate seller, right? And that is what is making news from 26 September 2024 that they have sold so much of Indian equities, right? And that makes the market the way it is correcting. But consider if you are not an FII, or you wanted to invest, you have money, you don't have any problem. So what you should be doing? So for example, if I am a DII, I can only buy when the FI is selling at corrections. If correction is new to my behavior, or a DII is selling and market is correcting, I can never buy because I am the part of the DII. So one, you can only encash benefit out of any correction if it is an FII is seller. Now, the second point is why FI is selling. Do they don't like India anymore? Number one, if there is a problem with India growth story, so what could be the case? So there are three reasons why they are selling in Indian market. One is the bond yield in US is going higher and higher, right? So before COVID or throughout the COVID, it was less than 2%. Now it is 4.7%. So it is more than double, right? So when the risk-free rate is say 4.7%, you will take out some money from across the world to your own home, because you want to have a benefit out of the high bond yield, which is a risk-free rate of return, right? So that is one reason. And if I am, as an Indian investor, if I am getting a 12% risk-free rate in India, I would also put some money into bond and reduce my risk from equity. So that is what is doing. The second thing is, in last 10 years, in dollar term, emerging market has not delivered good return. So emerging market is a basket of some 30 odd countries, where China used to have a highest weight, which was 40% 3 years back. Now the weight has reduced and close to now 21%. And India weight has increased from 7% to 22%, right? In emerging market index. Now that index as a whole has not delivered return in dollar term. So it is lesser than US equity return. So what an investor would think, if he is an FII, why should I put into a risky equity where I'm not getting good return even after 10 years? And the reason for not good return is actually China. The emerging market basket, only India and Taiwan has delivered return. All other 28 countries has not delivered good return. So they wanted to sell the emerging market index, right? And when they are selling it, they have to sell India also, because you can't sell any country separately. So for example, there are 30 countries. China's weight is say 22%, India's weight is say 21%. So they have to sell in that manner. So they are selling India because they want to sell emerging market index that we termed as MSCI emerging market index. And that is another reason they are selling from emerging market basket. And most of our FPI money is through emerging market basket and not through India dedicated funds. So 60% is through that emerging market index. So that is one is a technical reason. And the third thing, when there is a global uncertainty across the world because of wars, because of geopolitical, there is a natural tendency to take your money to your home. That is also called home country bias, right? So for example, if there is a too much of rain in Mumbai in July, right, the HR instruct us to go to home, and we also run for or rush for our home. However, you may think that the office can be safer place than your home, but still you rush to your home because you always feel safer at home. And that is called home country bias. So whenever there is a geopolitical scenario, people tend to pull out their money from the foreign nation to their own nation. And these are the three reasons they are pulling out money. And that's why the market is correcting and they are selling it heavily. Now, how much heavily, how much they have sold, that is a different question. But if I have to give a number, it is only 0.2% of the total holding that they have sold from India, right? Only 0.2% of the total holding. So it is not a mass selling which is happening in India. It is, so sometimes they have sold 0.5% of the total holding. Sometimes they have sold 1% of the total holding. This time only 0.2%, right? And that is what is the reason. So it's not like that the FI is selling very heavily in percentage term. It is not that much great. And that kind of money can be pulled out anytime. One should not worry about it. So one, they are not selling because of India. They are selling because of their own issues and their own problems. And that's why the market is correcting.
Chirag, you told me one thing. In the last 30, 40 years of markets history, markets have corrected approximately 47, 48 times,
Fine.
right? So when the markets correct, they leave behind certain lessons for investors to learn from. It is said that history repeats and many times history rhymes. What lessons can we pick up from the history of market corrections and how it can guide investors in their journey of investment going forward?
So first, whenever the market correct, how one need to think. So first thing that I have told, all market has recovered. Number one, all market correction has recovered, right? And one need to explore why somebody is selling very heavily in India. If it is because of domestic issues or India specific issues, right, then you have to worry. But if it is not because of India specific or a domestic issue or a market specific issue, this correction can be a good opportunity for someone to invest. So problem for someone is actually opportunity for someone else, right? If I made some losses in my businesses and I wanted to sell my house desperately, I have to sell it on discount because then only I will get quick money. Now, am I selling that house because of there is a problem with the house? The answer is no. I'm selling because I am getting troubled by any of my own other issues that are actually a good opportunity for any investor to make advantage out of that situations, right? So one should also learn whether during this correction, economic fundamental of the country has deteriorated. If the answer is no, then you should take advantage out of it. If the earnings are going to be good, if the economy is growing, you don't have to worry. For example, just an instance, will it change the fact that India will become the third biggest economy by 2030? The answer is no. Will it have any inference that Indian people will consume less because of FIS selling? The answer is no. Then one should not worry about it. The reasoning, because if the economy will grow, the earning will eventually grow. And if the earning grow, the market will follow. That is what is the basic fundamental of investing that one should follow. So for example, I give you an example. If I wanted to buy a car and the car cost me 10 lakh rupees, right? And I'm not buying it because of XYZ reason. And if there is a slump on car sales during that period, the dealer may give me a discount. Say, okay, I will offer you 10% discount. So would you like to buy it at 9 lakhs? So I think it is a good lucrative offer, and I have started considering that offer. So that is called 10% discount, right? Now I'm not responding to the dealer in next week or a coming times. He may wanted to give me further discount, but this time the discount would be very different. He may ask me that, okay, I will give you accessories worth 1 lakh rupees. Right? I will also add that accessories worth of 1 lakh rupees. Now would you buy it? Now, if you see, the first discount was in terms of price, and the second, he upgraded value of the car. So which is a value addition. So I'm getting worth of 11 lakh rupees car at 9 lakh rupees. So my total discount is now more than 10%. So what happened during the corrections? If the earning kept on growing, your correction would be bigger than what it appeared by just calculating the price correction. So for example, sometime the price correction is say 10%, but during that time the earning improved by 5%. So your total valuation discount is 15%. So people generally see price discount, but they do not see a total valuation discount because there is some value upgradation also. So for example, when the Russian-Ukraine war happened, the market corrected by 15% in 6 months, but the earning also improved. So if I combine all this two, the total discount was at 27%, right? So what investor need to see, not look at only price correction, but also at value upgradation that happens in form of earnings from the underlying assets or underlying equities. So that is what. So for example, from January onwards, the earning season will start, and if the earning is as per expectations, you have to add those value to that discounts. So that is what one need to correction. So nothing has changed because of FI selling. We are still teething brush in the morning. We are still having cup of tea. We still have biscuits with the tea. We still roam with the car, and we still fuel our cars. We still buy apparels. Only the headline has changed. Yes.
The music of the season has changed, and the newspapers and television channels are having best days because they have sensationalized everything. So they are making everyone sit alert now. That's
Yes, exactly. Exactly. So all this correction are already inbuilt into the system, but we start thinking about it too much once it start appearing on the surface. Otherwise, nobody was worrying about, FI selling before that because the market was not correcting. Once the market start correcting, we start exploring the problem, and we start exploring the problem, you find more cockroaches. So if there is one cockroach, and if you explore, you will find more cockroaches, and you start worrying about cockroaches. So it would be everywhere, and it is, throughout my house. So you get into the panic, right? So that is what is the problem. So how to think is the, biggest lesson that I have learned during any time of crisis. First, I learned is do not get panic. You don't need to extrapolate things, right? And there is a theory called mean reversion. So that is what investor need to think. And during problem, you find many people will explore that problem and they come out with 10 more problems, right? So, but when there is a bull run, the problems are still there, but you have not explored it. So if you have not found any cockroach in the house, it does not mean that you don't have any cockroaches. The cockroaches stays with us.
That's why they say during the bull run, markets neglect the bad news. In the bear markets do not identify the good news.
Exactly.
Right? So this is what exactly happens. Let's accept the fact investors panic. It's natural. See, if you are a pilot of the plane and if there is a turbulence, you know how the technology works and it's not going to be a problem. But for a passenger, there will be butterflies. I'm a seasoned traveler, but every time there is a turbulence, it's a human reaction that you feel jittery, you feel what might happen. So people need reassurance. People need to be handheld to give that comfort. What do you feel that the investors should be focusing at this point of time so that they'll not be taking any wrong decisions at this point of time? How should the investors really think at this point of time?
First thing that I wanted to tell is there is a famous dialogue from a Hindi movie called Three Idiots, all is well, right? That is the first thing that you have to say to your heart, right? And you have to think from your brain, not from your heart. So that is one thing. The second thing is keep focusing on long-term goal And you should think throughout your goals, talk to your advisors, and always keep a close eye on your long-term goal. Right? Do not try to explore too much into the problem. Maintain your asset allocations. That is the first thing. Most of the time, what I have observed, most of the panic is due to not following asset allocation. Putting 100 rupees into equities, right, before the correction, because before the correction, the news were very good. And I have heard instances that people have invested tuition fees of their kids into stock market for 3 months so that it can appreciate. Now, these are the people who get worried the most. A businessman who has invested his working capital money into the stock market because last 4 quarter he made good money out of stock market, and this time he has invested higher amount for next 3 months. So this is called grid, and this is called you are crossing the boundaries of investing. So if you are not maintaining your asset allocation, you have to worry about everything, whatever happening across the world. You have to think about Trump also. You have to think about, you get worried about Israel and Iran conflict also. You have to worry about Jinping also, and you have to worry about Nitish and Naidu also. So this is what is the issue, that not maintaining asset allocation. First, if you're not maintaining asset allocation, your portfolio corrects more than the market, or it will fall with the market. And during correction only, you will get emergencies. So, for example, you will get emergency in terms of medical emergency. There can be a chances of job loss. There can be a chances of delayed payment. All these happened because of market corrections. Because if your vendor or if your customer has invested into stock market to leverage position, he has made losses, he will ask for money earlier. So it is an entire ecosystem which put pressure. So if you have seen, whenever the market corrects, emergencies always start appearing on the surfaces. And that is because of entire economy as a whole is leveraged, or there are undisciplined investors which are into the ecosystem which put pressure on you if you have not made any mistakes. So first, maintain asset allocation. You have to make adjustment, and you have to think that how the entire ecosystem is working. For example, if you are driving a car perfectly, right, then many people that they don't have to worry about it. But if somebody will come and bump into your car, then your airbag should at least save you, because you have not made any mistakes. So like maintaining asset allocation is having a brake in your car and having an airbag into your car.
People forget that they have a gearbox and the car has a first gear, second gear, third gear,
Third gear, fourth gear.
gear, but they will say only fifth gear to be used, not to. There is no utility for first gear and second gear.
Exactly.
So when the bull markets rage and when everything happens, whatever that the investor wishes, the rationality goes out of the mind. The investors always have a problem. In a falling market, they ask, why did you put my money into equity? In a rising market, they ask, why are you keeping money in the debt funds? So they don't listen. See, only over a period of time, people become mature that there is a virtue in maintaining asset allocation. There is a role for every kind of a fund to be maintained in a portfolio. People should not pick up individual funds. People should look at a portfolio in total. I often keep telling people, look, it should be a balanced meal. Your meal should have, the
Exactly.
spicy things. You should have salt. You should have sweet. Don't fill the plate with only one type of food. It's a balanced meal. That's the way it should be like.
Just to add, there is a famous book called Intelligent Investor, right? It is called, Bhagavad Gita of investing. But the problem with that is, it is like Bhagavad Gita. Nobody reads this thing also. The book is also, in that book, it has been mentioned that an enterprising investor, so he is the risk taker in true sense, should put 75% into equities and rest into non-equities. And you won't believe, from 2006 to till date, I have done a simulation with 75% equity and rest non-equity portfolio. This portfolio delivered higher return than 100% equity portfolio. So because, and brakes in the car are not there to reduce your speed. Because there are brakes in the car, you can drive it at 80 kilometers per hour. Otherwise, if there is no brake in the car, you won't even drive it. You can't even drive it. So that is what is the issue with investor. If he create a portfolio of 75% equity and rest is non-equity and market is booming, he may ask and come, okay, this 25% is not fetching anything to me. So remove it from the portfolio. It is like just removing brake from your car.
Exactly. See, I can visualize, you can visualize this point. The ordinary investors finds it very difficult. One of the reasons why investors get into this problem is they cannot visualize how the returns are coming. Let's say that a small cap fund has given 35% return in the last 2 years. So he will visualize it like a fixed deposit, which is giving 35%. And he extrapolates it for next 3 years, 5 years, 10 years, lifetime. And he thinks that's the way it is going to behave. So the investors do not visualize. Investors do not visualize that debt funds have a constant forward movement. Equities move up, come back. There is a forward, there is a backward movement. There is a snake and ladder game which happens in an equity. Whereas a debt fund or a hybrid funds, most of the times will have constant forward movement. And when the equities are taking a backseat, they will not realize that it is these debt funds which are keeping their portfolios in a much better way. And they will serve as cushion funds in the event of emergencies, what we talked about. It's a Murphy's Law. So when everything is fine, nothing goes wrong. When something goes wrong, everything starts falling apart. So it's a natural reaction. Based on this, what do you suggest the investor should be cautious about, either buying or selling or panicking, or to remain as a do-it-yourself investors, or how often should they go to a advisor? Based on your experience of last 15-20 years, what is the message you have for the audience?
So during such correction, how an investor can make most out of this correction is, one, maintain precaution before market correction. So how it can be possible? Through asset allocation. So you can always prepare your portfolio. You can't predict any event. So for example, COVID, we could not predict. Ukraine-Russia war, we could not predict. Subprime crisis, we could not predict. So you can't predict. You have to prepare your portfolio through asset allocation so that you can make most out of any market correction. And at that time, your portfolios should be in good shape. So whenever market corrects during any such crisis, what will happen? Either you don't have cash to invest or you don't have courage to invest. If you have cash but no courage, we can give you courage to put. But what if you have courage but no cash? We can only tell you that, okay, wait for market to recover. So that what is the thing that you should do before this correction is maintain a good allocation in your portfolio, which is called asset allocation. So for example, an enterprising investor can have 75% into equity and rest into non-equity. A moderate investor can have 50% into equity and rest into non-equity, like debt and gold. And a very conservative investor should have 30% into equities and rest into non-equity. So that is what is the fundamental rule that investor need to follow. The second thing is, generally when you have money during the correction, you buy the previous pad. So for example, during COVID-led correction, people bought pharma stocks. But in next 3 years, the pharma couldn't deliver any return. It is the worst performing index out of all the indices. Before subprime, people bought infrastructure stock and it recovered. It took some 7-8 years to recover from there. So generally people buy fad of previous market bull run. And what is a fad? That everyone is chasing it. So how to think during such kind of event is, there are second level thinking and there are first level thinking. What is the first level thinking? If the company is growing and the earning and prospect are good, let me buy this stock. This is called first level thinking. But the world is doing the same. It means everybody is thinking the same and everybody is buying that stock. What does it mean? The stock has become overvalued. The earning has improved by just 15% and the stock has appreciated by 50%. So it is kind of overvalued. And whenever the market corrects, as per the Newton's law, action and reactions are opposite. It corrects more. And what happened, that the economic scenario will also change after that. Right? Everything was going good for that sector. So everybody is buying those sectors, and that's why the stock and sectors become overvalued. And after the market correction, the situation turns, the table turns. So it is just like in Formula 1 race. At turning point, the position gets changed. So when the market recovers, something else will start recovering. So the common mistake that I have seen people during such market correction, when they show some guts to invest, they buy the previous fad. For example, this time defense, railway stocks, small mid cap and SMEs. This is what is the fad. While if you see among the spectrum, the large caps are the most attractive one, right? And that is what one should look at as an investor while such correction is happening.
Chirag, each bull market has a fashion of its own, and each bull market is led by a particular set of stocks from a particular sector. When bull markets give and to bear market, and when a new bull market start, is it the same fashion which continues, or there is a new leadership which will emerge and people should look for those new sprouts to make money out of the new bull market?
Exactly. One and the most important thing is where the next growth is coming from, right? And what is available at good valuations today? These are the two questions that one should ask. And it has been observed that the next recovery or next run would led by different part of the economy, and the different stocks will start doing well. And the market has its own way to find those ways, right? And that is what is observed during any recovery or any bull market. And new sector emerge and they grow faster than the rest of the sectors. So initially what will happen, only few smart looking people start buying those ideas. Then the stock started doing well. Then more and more people join the party. And at the end, the masses start joining the party, which is happening into new sectors. So it is like, what a smart investor does in the beginning, the dumps do at the end.
Maybe we are talking about the PSU now, because in the last bull market, nobody wanted PSU. And I still remember, painstakingly Prashant Jain telling everyone that it's the
Yes.
PSU which will lead the next. And he went and created positions in his funds which he managed. It's rather unfortunate when the PSUs became a fashion. He was not managing those funds. A great fund manager by any stretch of imagination. And it's a question of patience and conviction. So you mentioned about courage and cash. I will add one more conviction. One should have conviction, one should have courage, one should have the cash. Only when you combine three C's, then you can really make money. The fourth C could be, it should be a contra. You invest in a contra with the three C's what we spoke about, and that would be a dynamite of a combination. Anyway, that apart, the investors come and go in the market. Investors come when they think that there is a bull market which is about to happen. But to make money out of the stock market and to reap the benefit of power of compounding, what is an ideal time frame an investor should remain invested, and how many times he has to go through this rigors of bull and bear markets? What is your experience, or what is that message you want to drive home to the audience? This is my last question to you, because unless we drive home this particular point that, look, you should be, it's just not committing money, you should also be committing time. When you have committing time, then you should also garner that courage, conviction, and that mental belief that I'm going to stay here, let anything happen. Everybody is worried about where the market is going to be next month, next year. But nobody is worried about where the market is going to be 5 years or 10 years later. How should the investors keep their expectations? How long they should remain invested?
So I think there is no very specific answer, but from the history, the general economic cycle and market cycle remain for 8 to 10 years, right? And all the overvaluation, undervaluation, sentiments thing will get even out during those periods. So I think 8 to 10 years is a good investing period to reap minimum 8 to 10 years is a good investing period to make most out of it. Whatever higher than this is always advisable, but that is the bare minimum period one should be investing, because you will get at least one bull run within that investing period, and you can see many corrections. So that should be the right investing horizon. For example, if you have invested at the COVID bottom, right, and you have pulled out money once your money get double, then you made money, but you would not let it compound. If you have invested before COVID, right, and you have invested throughout this period, your money is still growing at 15%, right? So at the peak of the market you have invested, today your money is almost double. At the bottom of the market, and you have not invested for, say, till date, you have not allowed it to compound, even if you have get it at very right prices. So that is the two things that one should, that if you buy something at any valuations, if you keep your holding investing horizon, so 10 years, 15 years, it doesn't make much difference who has bought at the bottom. So that is one thing. The second thing is, if you can manage to buy at corrections, right? So you sense the opportunity, for example, so that you have decided to invest. So you have seized also. You have seized the opportunity, but you have not sized it well. So sensing the opportunity, seizing the opportunity, and sizing the opportunities. These are the three aspects of investing that one should look at. Stay invested for a long period of time. So let the money compound. There are many bull runs which you will enjoy then in the future.
Dear viewers, we had done an earlier video with Mr. Chirag, a beautiful video, a video which is filled with facts and figures, how to make most out of the SIPs. I request my editing team to show the thumbnail on the screen. If you have not watched this video, I would suggest please watch this video, and amazing facts are presented in that, and you can make most out of that video. Please do watch that. And Chirag, I'm always, puzzled. Investors are intelligent, no doubt about it. But when it comes to a question of investing, it gets into an inverted kind of a thinking. People drive cautiously when they drive the car. But when it comes to question of investing, they become reckless. People are prepared to give time for everything in life, but people are not prepared to give time in the stock market. They are prepared to wait for 6 years for the child to go to school. They are prepared to make their child study for 15 long years to get into that basic graduation period. But investors are not prepared to give 2 years, 3 years, 5 years in an investing world. They become, restless because of this. You said one thing which is very, very right. Investing is easy, but not practicing investing is not easy. Advising easy, but keeping the investors, believing that this will work is not an easy time. I keep telling my team, look, investors always have a problem. In a rising market, they ask, why are you keeping the debt funds? And in a falling market, they ask, why did you not exit this particular fund? Is it possible for an investor to identify the topmost spot and walk out, or identify the bottommost part and get in? The timing part of it, is it possible to time it?
If the magician can really pull out money from his coat in unlimited amount, he can never do magical shows. He should never do the magical shows. So similarly, I don't know what is the bottom of the market. And in this world, except God, nobody knows what is the bottom of the market and what is the top of the market. So that is one thing. It is not even difficult to time the market. It is impossible to time the market, and you should never attempt to do impossible thing. So that is one is, I think, my way of investing and my style of suggesting. Do not try to catch an either bottom or the top of the market. You have to prepare your portfolio. So the risk is not into the market. The risk is into your portfolios. You can only manage your portfolio well. That is the only way to grow your money.
Thank you, Chirag, for all these beautiful points. And when I keep talking to you, I keep getting ideas about what are the videos that we need to prepare. You come with such refreshing thoughts, and the experience speaks here. Thank you very much. And I'm very sure my audience will pick up good points from this video, not panic from this correction, rather get those beautiful points to identify the opportunities in this correction, not fall prey to the fashion of the yesteryears, hoping that the same fashion will repeat again. Thank you very much for your kindness to spare time and talk to our audience. I remain in gratitude to you, sir. Thank you very much.
Thank you. Thank you very much to you and your viewers. And happy investing.
Dear viewers, hope the video that I have done with Mr. Chirag Patel helped you to understand what are the lessons we can learn from the history, what are the precautions that we can take, what is the time horizon we should look at the time of investing. If you can take cues from this, you will have very pleasant experience out of this investment journey. If it helped you to understand all these final points, please do give me a thumbs up. If you are somebody who is yet to subscribe for this channel, please do hit that subscribe button and press the bell icon. Do not forget to share these videos with your near and dear ones, friends and relatives, and on all the WhatsApp media on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another thought, with yet another expert next Tuesday. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.